Welcome back. My name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, we're doing a video that is just absolutely overdue. I've been meaning to make it for like over 2 months now. We're finally doing a video on transmedics, which at the time of this recording, it makes up roughly 2%. Actually, I think this is a little bit dated, so it does in fact make up 2% of my portfolio. This is very off-brand for me. It's a small cap and it's a healthcare company, which we'll get into later on in the video. And by the way, I should mention my portfolio is always going to be pinned at the top of my Twitter page, the most current version of it. Link is in the description if you want to go follow me over there to see the most current version of this if you're watching this sometime in the future. With that being said, let's not dance around it too much. Essentially, this is a business that can prolong the life of an organ. And so like traditionally, when it comes to patients in the hospital that sign up for organ donation and that type of stuff, what they typically do is they just put it on ice until maybe, within like a 50-kilometer radius, roughly, you could probably deliver that to nearby hospitals to a patient who needs it and that type of stuff. And so in today's video, we're going to kind of look at these guys, which they've been able to make the only FDA approved machine that can prolong the life of these organs. And so it's kind of able to be sent all over the place and get to other patients that maybe need it more urgently, or patients that, like, for example, if you live in Hawaii or whatever, traditionally there's like a pretty big logistic problem of trying to get that organ over there, or vice versa. If somebody passes away in Hawaii, getting it somewhere into the US, for example, and all this different stuff, right? So we'll kind of get into that. The first thing I kind of want to do is like introduce the company. This isn't your brand name Google or Amazon where everybody immediately knows what their business model is. So we'll kind of go through the investor presentation, do that. Afterwards, I do want to jump over to FinChat and go over like essentially all the numbers. It is a very small $2 billion market cap business. So it's definitely important we go over the numbers and that type of stuff. A little bit difficult. Again, it's a smaller business. They're just ramping on profitability, that type of stuff. We'll do all that stuff later on. But first and foremost, this is the most recent investor presentation that they've put out. It's from October 2024, but as we'll go down, you'll see some of the numbers is not from 2024. So we'll see that as we kind of go on here. First and foremost, you scroll down after all the disclaimers and that type of stuff. The first thing they put in front of your face is this chart right here. It says transplant challenges, massive underutilization of donor organs for transplants. And they show you here, they say in 2023, the total number of organs that were deceased, by the way, they only specialize in 3 areas. It's lung, heart, and liver transplants. Of course, liver makes up the bulk of that. And I believe lung is the least in terms of revenue. So even though you see in total volume, lung is comparable to heart, this one brings in the least amount of revenue, right? It's much more expensive to do heart transplants and slightly less expensive, but still very expensive to do liver transplants compared to lung, which is negligible, right? And so as you can see, between the 3 of them, there was roughly 16,000 total donors available, but not all of these were able to be donated to another patient. So there's a good amount of volume in between here for whatever reason. Maybe it's delivering it or whatever the case is. It's not able to get to a person that may need that organ, right? And so here they show us, they're very proud to show us that this is a business that they've been working on this for decades and decades. Maybe not decades, I think around 15, 20 years they've been working on this. And you could go back, you could watch YouTube videos from like a decade ago of them showcasing the first versions of these machines. And as it stands today, and you could even Google this and look for yourself, if you simply search up FDA approved organ care systems, because this is what they are, the machines that they sell, they are called OCS or organ care systems. And, actually the Gemini summary, it lets you know, it says the FDA has approved several organ care systems, including the TransMedics one for lung, the TransMedics one for heart, and the TransMedics OCS for livers. You might notice a trend there. These are only TransMedics machines. So as it stands currently, the only FDA approved organ care systems that are on the market are the ones by TransMedics. So if you're a hospital and you want to purchase one of these compared to just traditionally putting it on ice, the only one you're allowed to use and purchase is the one from TransMedics. And then they make a quick mention here that it takes 80,000 per use. Keep that number in mind when we wrap back to like why they're kind of building an early moat. That number is going to be important because it costs 80,000 to make them. You'll start to notice some duality with the classic Polaroid business model. Going down here, they go through some logistical challenges and that type of stuff. Again, this kind of tying back into the moat. So maybe we'll talk about that a little bit later on. Another interesting thing that this kind of ties back to the initial slide actually is they see that TMDX's volume of heart, lung, and liver, which again, lung is like negligible revenue, but still like it's included in the total volume number. This has been growing 130% year over year. Keep in mind, this is what I was talking about. This is 2022 and 2023 numbers. So slightly delayed. The growth rate has went down since, but still it's like impressive growth. And then this ties back into the 16,000 number in terms of total donors. So as you could see, they have roughly 15-ish% market share, maybe closer to 20% now that it's been like around a year since. And then here they specifically break out heart and liver transplants, right? So in terms of heart transplants, there's 4,000 of those per year. In terms of liver transplants, there's 9,500, right? So again, going all the way back to the 16,000 number that we have up here. The bulk of that is in fact heart and liver, which is where they make the bulk of their revenue and the bulk of their profits, right? So those two things are naturally growing at 12%. And then TMDX as a percentage of total US heart and liver transplants, they're taking market share against their competitor, quote unquote, the competitor of literally just putting it on ice, right? And then here, this has become a bigger and bigger part of the thesis with this business, and there's arguments to be made on both sides in terms of, is this good or is this a deterioration of the business model? Because at the end of the day, like if you're a medical devices company, and we could maybe even pull up, for example, what's the name? iSurge, Intuitive Surgical. Intuitive Surgical is a very, very high margin business. They have operating margins of 26%, free cash flow margins, net margins of 30%. So it's a very high margin business. Maybe we could pull up, for example, another business we could pull up is Stryker Corporation. I believe they sell all types of like orthopedics and like spine and that type of stuff. So again, another medical devices company. They also have like 20% operating margins. Net margins seem to be a little bit lower. Of course, I would assume with orthopedics and that type of stuff, they have competitors with that. They also have like hip replacements, knee replacements, all that type of stuff, right? So again, going back to TransMedics, like when you are a medical devices company, you naturally will be able to charge high margin for stuff because this is stuff that people need and it's complex and that type of stuff. And so naturally, when you hear that they're starting an aviation division to kind of help actually move all this stuff around, which going back to the slide about difficulties with their current business model is that there's a lot of trips where it's not able to happen because they need to rely on these third-party private aviation businesses. And so actually they purchased an aviation company, a very small aviation company with like 2 different planes. And then they've recently been buying a bunch of different planes in order to kind of cut out them relying on third-party companies. And so this way they have it 24/7. They have a dedicated fleet and crew that doesn't need to fly into where the thing is. It could be located and all this different stuff. And there's a lot more efficiencies that they unlock through doing this. The issue with that is aviation is very costly and it's not a great business. So naturally, when you cut out the third-party aviation business, instead the hospital will now be paying you extra for the mileage and moving that organ from place to place. Again, naturally, aviation, you're competing with other aviation companies, so you can't really charge a crazy margin on that part of the business. So you move from like a 80% gross margin business down to like whatever aviation is, I don't know, like 20, 30%. Naturally, it's going to tank your gross margins. And so again, as of October 2024, which is like pretty recent, they had 18 dedicated jets that were full-time operating. I believe they had a couple of them down for maintenance during the quarter, but they have these planes in order to kind of handle the logistics of their business. And so that's about it. They have intellectual property, which is their OCS. They say they have 400 issued patents around the world. And so they are also, again, I'm going to remind you, the only FDA approved organ care system. And that right there is like essentially the kind of early monopoly that this business has. Of course, it's going to be proven over the next kind of decade as other competitors, and there already exist other competitors, they're just not FDA approved. As they kind of come into the scene, eventually get FDA approved, we'll see how the industry plays out. But as it stands currently, TransMedics is the only FDA approved company that's able to even conduct their business. And then you add on the fact that they have now bought their own aviation company, for better or for worse, that makes it kind of like a one-stop shop for any hospital in the US, where if you go with TransMedics, you have the guarantee that they will handle from 0 to 100. They'll handle everything, including the logistics, which is like a big portion of, having the successful organ transplant and all that type of stuff, right? And then on top of that, you kind of add a small but growing moat in the sense of the switching costs, whereby switching costs, and maybe we tie in a little bit of network effects here as well, right? So obviously these are very complex machines and it requires a certain amount of training with using these machines. And over time, because they're the early category leader and monopoly currently, more and more hospitals are going to adopt them. Again, I'm going to draw your attention back to the 15% number we had earlier, whereby they're currently accounting for, in the US right now, they account for, well, I guess probably a little bit more now, but in 2023, they accounted for 15% of total transplant volume in terms of the liver and the heart. Over time, very obviously, because of just purely, being able to extend the duration life of these organs, naturally over time, they're going to be taking market share from quite literally just putting it on ice, right? So as this starts to happen, more hospitals start to adopt it. That means more and more staff are going to be trained on these machines. Naturally, that creates a little bit of network effects, whereby if you are, for example, working in, New York, and then you hop over to New Jersey in a different hospital, if they have the same machine, it's easier to train staff, or I guess you wouldn't even be training them because they already know how to use it. And so it kind of spreads from there, where it becomes the standard choice for all hospitals and all nurses and all doctors around the US to be using TransMedics because everybody knows how to use it. And it's like the gold standard of it, of organ care systems, right? And then on top of that, there's another aspect to it where you start to see a little bit of switching costs where, sure, there's the time and headache and all that type of stuff of once you started using TransMedics, you're not going to switch to a different system because that means all your staff are going to have to relearn it, and relearning not only is costly in terms of hours where your employees are working inefficiently, but it's costly if something messes up. And actually it's costly where a organ could come in and for whatever reason, if your staff makes a mistake, that could be somebody's life right there. So it's better to kind of pay the premium of staying with TransMedics and ensuring that you have the results and for certain that you're going to maximize the number of successful transplants. And so what do I mean by paying the premium? Paying the premium in the sense that, in theory, if they do eventually become the standard, they would naturally start to, unless some regulation came in, but they would probably be able to charge a premium on the one-time use items of their machines. So, and maybe I should just pull up a picture of, so these machines that are used for, transporting the actual lungs and hearts and all that type of stuff, they obviously have some components that are one-time use. The actual plastic, the container, all the different components around that, certain, chemicals they got to punch into the machines, whatever the case may be, right? So there's definitely some one-time use items. And so that accounts to $80,000 worth of these things that you need per organ that you're moving. So it's actually very expensive to move or to kind of store these within those 24 hours. I've been kind of Googling for a little bit here. It's difficult to find the exact cost of the machine. I do recall a number in the couple $100,000 range being thrown around. I could be completely wrong on that. But anyways, I think the actual machine's cost is a one-time cost for the hospital, a couple $100,000. And then it costs the hospital, again, about, call it 60 to 80,000, give or take, depending on a bunch of different factors for all just the one-time use items, right? So then the hospital on the other side, because of the employees and all that type of stuff, they're charging you multi-hundreds of thousands of dollars to actually, do the surgery and all that type of stuff for the actual heart transplant. It could cost, $250,000, $500,000, whatever the case is. And so again, goes back to their switching costs in terms of once you've bought the machine, obviously, if you want to switch for whatever reason, maybe TransMedics is charging a premium on the one-time use items. There's a switching cost whereby you've already purchased the machine. It's working perfectly fine. Your staff know how to use it. You guys get the point here, right? It's the classic Polaroid model of sell the camera and then they need the film to actually take pictures. So then you start selling that film over time, and that's how you make the bulk of your lifetime revenue on that customer. So with that being said, let's dive into some numbers. I don't have a set number of things that I kind of want to talk about. The main thing to look for with this business is the actual revenue growth. And so if you look at the revenue growth of this business over time, they've gone from just borderline no revenues to now making $400 million of revenues. It's a business that's growing incredibly fast. In the past 12 months, they've done, about $400 million in revenue. But you might notice, and if we toggle on the percentage change, Okay, I've moved around the colors so you guys could see better. In the past 12 months, they've grown revenues at about 100%. But then if we go down to the quarterly view, you could see that the growth rate dropped from 120% down to 64%. And this is the main reason why the stock is down a lot. If you didn't know, the stock was making all-time highs of like $180 a share. It's now in one of its worst drawdowns ever. By the way, website we're using, finchat.io, it's the only sort of sponsorship or anything like that I've taken on the channel. And so over here, we're looking at the drawdown feature on the stock price. You could see the worst drawdown it's ever had was a negative 70% from the all-time high. Recently, it's went down 65%. Doesn't seem to be out of the ordinary for this type of business. It is a small cap at the end of the day. They do these they behave in this matter. What do we have? We have more than 60% drawdown. 1, 2, 3, 4, 5, 6. We've had 6 60% or greater drawdowns in the past 5 years alone, right? So it's a small cap. It's a small cap. It behaves like this. It does this type of stuff. I wouldn't personally be worried. I started buying at $130. My average is $90 per share. And I'm just holding. I'm not doing anything, right? Going back to the revenue though, the revenue recently slowed down to a 64% growth rate. And then if we actually look down into the specific segments that are slowing down, over here on FinChat, we go down to the segment and KPIs tab, and they actually break it down for us. So we're going to look at net product revenue, which this has to do with the actual, the product that Transmedics is selling. And then you have your service revenue. Now this, I believe, takes into consideration both the one-time use items. So that counts towards the service revenue. And then on top of that, this also includes the logistics, right? So we could see that the logistics segment of the business and the one-time use items and that type of stuff, that is the bulk of the growth of this business. That's growing at 130%. And then you have net product revenue, which is growing at 40%. And then naturally, the next question you might ask is, okay, but these two segments, what is the split of revenues on those two? And we could also pull that up. We look at common size, and then I'm just going to click on the stacked bar chart, and you can see that the product revenue, so actually selling the machines, makes up 61% of the revenue from this business, and then the services they sell on top of that, that is making up 40%, and it's making an increasingly larger portion of the total revenues that the business generates. Now, another thing you might naturally question is what is contributing to the slowdown of revenues? Why did we go from over 100% growth down to 60% growth? And so I'm simply just going to ask the FinChat Copilot here, what has Transmedics management said about the revenue slowdown in the most recent quarter? And what it's going to do is it's going to go through and look at all the conference call data and the transcripts and all that type of stuff. And it's able to kind of pull information said regarding my question. And so here, the Copilot was able to find that the Transmedics management addressed concerns about the revenue slowdown, which again, it was quite literally a halving in terms of revenue growth rates. And during the Q3 earnings call, which is the quarter where the slowdown happened, there were some key points discussed. So they said the overall decline in the U.S. transplant volumes, the company noted that a decline in transplant volumes across liver, heart, and lung in the U.S., which aligned with national trends. Importantly, they emphasized that this was not due to competitive dynamics or loss of market share. And while this sounds like, oh, okay, well, yeah, the total market as a whole slowed down, so they also slowed down. The thing to note with this, and I didn't think of this, Brian Feroldi, which I actually found the stock from Brian Feroldi, so big shout out to him. That's where I got the bulk of my information about the stock to begin with. But what he said, which I completely agree with and makes sense to me as well, was, okay, so the slowdown happened because of national slowdown in terms of transplants during the quarter. Great. Aren't you the business that is supposed to be taking share against putting the organs on ice? So if you're growing similar to the national trends, or like if that's something that is already impacting the growth of this business, that means that you're probably capping in terms of the total quote unquote market share you're taking against putting the organs on ice. That's something that's worrisome because that just shows that there's a good, and we don't know the splits on this, but there's a good amount of organs that don't require, or for whatever reason, will not be going on OCS systems anytime soon. They did emphasize that, no market share was lost, but to kind of flip that the other way, that means that no market share was gained either. And we're not taking market share from competitors, we're taking market share from putting it on ice. So if you're already being impacted and kind of capping out at that, sorry, I didn't mean to hit the mic. If you're already kind of capping out on the 15% range in terms of the share of US transplants, that's something that's naturally worrisome. Maybe this company is hitting maturity far earlier than we expected. They're probably going to have that revenue growth rate slowed down even more. And so they talk a little bit further about it. They mentioned there was a decrease in revenue outside of the US, which was anticipated as the company had some stocking orders in the first and second quarters that did not recur in the third revenue. I think this is just them moving internationally. They also mentioned that they had fewer planes than they anticipated, so they had a lot of them going under maintenance. That's in my opinion a more plausible explanation towards the revenue slowdown. Naturally, if you don't have that many planes yourself able to do these missions, then that would probably affect the total revenue. Now, the interesting thing that they do point out here is that they actually guided for revenue in the next quarter to be higher than the revenue growth rate in the most recent quarter. Or sorry, they guided for the full year to be between 76 to 84% revenue growth rate. And so this gives me a little bit more confidence in them being able to kind of explain this away as like a one-off quarter. But nonetheless, like this is a $400 million revenue business. And so naturally, like once you get closer and closer to $1 billion revenue run rate, the ability to grow at these like extremely fast revenue growth rates of like, 50, 60, 70%, naturally the revenue growth rates just for any business in general, law of large numbers, that starts to slow down there, unless your name is Amazon, of course. But anyhow, this is a challenge of the business at the moment and has sent the stock down. Now, the last thing I kind of want to cover is, of course, the valuation of this business, which admittedly is unbelievably difficult. By the way, what I did here on FinChat was I just went over to the charting tab just because I want to put a bunch of different stuff here. And so first and foremost, let's just look at the forward PE of the business. I'm going to remind you, this is a business that only recently has become profitable. So questionable whether we should be using these massive swings in PE if, they're operating at like 1, 2, 3% net income margins. So instead, what I'm going to do is I'm going to just zoom in into the past couple quarters. You could see that recently, as of June of this year, they were at like over a 200 PE. And then now we're down to like a 50-ish forward PE. Naturally, you'd think that like, okay, that's probably like a pretty expensive business. But again, the thing is like this company is just now becoming profitable. And even at that point, like they're expanding this aviation part of the business. So like, I don't know. I really don't think net profit margin is something we should be valuing this business on at the moment. So instead, maybe we should look at, for example, EV to sales. So the enterprise value of the business, because of course you want to factor in debt, particularly for a early sort of young company. And so if you look at the enterprise value to sales of this company, you could see that like we're near the bottom. Sorry, I'm blocking it with the face cam here. You can see that we're near the bottom in terms of valuation ever for this business. And what I'm going to do here is I'm going to just toggle on the minimum line. So this shows us the lowest point it's ever traded at. And actually, it seems that we are at quite literally the lowest point this business has ever traded at in terms of EV to sales. And actually, another thing I'm going to do right here is I'm going to overlay the stock price to kind of see, okay, we definitely don't want that. I believe, toggle separate y-axis. So we could kind of see the correlation of the stock price relative to the valuation of the business. And you see that like, every time that it has traded, around this range, even below like 6 times EV to sales, it was probably a pretty good time to be buying the stock. Valuation isn't perfect with this one, but I think just purely looking based off EV to sales, or maybe if we want to toggle on price to sales, you could see that like it kind of trades at the lower end of its historical valuation range. Every time it's been, around the 6 mark, the 5 mark, give or take, it's been a pretty good time to be buying the business. But you should also be kind of thinking like, okay, this business is growing. They've become a bigger business. They're likely going to experience a continued slowdown in terms of their revenue growth rate in the future. So naturally, that should warrant a lower valuation. How much lower of a valuation? I'm not here to decide that. But again, something to kind of be looking at with this company. But even if we look at the recent historical averages, this is a company that has been trading up towards like a 20 times price to sales. They've averaged a 20 times price to sales. So a 5 price to sales is significantly below that historical average. Maybe we've adjusted for the continued revenue slowdown. I'm really not sure. And that kind of speaks to my position sizing, right? Like a position of only 2%. There's a lot of I don't knows and a lot of uncertainties around this. I like a lot of things about the business. That's why I'm invested in it. I think it's an early category monopoly. It's the only FDA approved one. They're creating slight network effects, a decent amount of high switching costs. They're growing into having this scale of managing the logistics and all that type of stuff and being the gold standard when it comes to if a hospital wants to get an OCS system, they're going to go with TransMedics because they're proven, because they already exist on the market, because it's the most amount of staff that are comfortable with using it. That actually kind of ties to Intuitive Surgical when we looked at it earlier. They make the machinery for surgeries. And so they've also carved out kind of like a monopoly status because for 20 years, surgeons, even going through medical school, they're taught to use the Intuitive Surgical machines. So again, kind of creates a switching cost, creates the network effects, all that type of stuff. And I see a similar thing happening with TransMedics, but they're way, 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 way earlier in that cycle, right? So a lot of things that I like with it, but of course they have the massive, massive execution risk, and they're just an unproven business. We don't know if they're going to be successful. We don't know if there's a better, well-capitalized business that's going to come into the market, take away their market share, do it better than them, throw a lot more money at a cheaper price and sign on a lot more hospitals, right? We don't know. It's way too early on to kind of decide that, but I like the current position of this business. That's why I'm invested in it, right? So, and I think it's an appropriate valuation relative to its historical price. I think it's a decent valuation at the moment. And then again, for full transparency, my cost basis is $90 per share. I started buying at like 125, 130, and I've dollar cost averaged that down. So that's kind of what I'm looking at with TransMedics. Of course, go do your own due diligence. This is a pretty difficult to understand business just purely because it's healthcare and most of us don't understand healthcare. So based off that information, do what works best for you. But yeah, I think I've hopefully given you a pretty decent overview of this business. I'm still learning about it. So if you're someone that's more knowledgeable about this, I guarantee you I made mistakes throughout this analysis. So please correct me in the comment section down below. I'm curious to learn more about the business that I'm invested in. I'm open to your feedback. Also, one last thing, finchat.io, completely try it out for free for 2 weeks. Link in the description. We've been using this beautiful software the entire video long. It's amazing. I promise you'll love it. With that being said, thank you very much for watching. Be sure to subscribe because it costs you absolutely nothing. Have a great day.